In this video, we will explore about risk management in the derivatives segment, specifically focusing on futures and options. Whenever you trade in these financial markets, there is always a certain level of risk involved. To keep your investment safe and ensure the market runs smoothly, the stock exchanges and clearing corporations work together to manage these risks. We are going to look at the comprehensive guide and the safety nets they use to contain and control these potential dangers. Moving on to how this safety net is built, you can visualize the risk containment mechanism as a strong shield supported by two main pillars. On one side, we have the stock exchange, and on the other side, we have the clearing corporation. Together, they utilize a very detailed and powerful framework to manage risks in the derivatives market. This partnership ensures that every single trade is backed up and secure, protecting the entire system from sudden financial shocks. The very first line of defense in this safety framework is called capital adequacy. Before any individual or company can even become a member of the exchange to trade or clear transactions, they must meet some incredibly strict financial requirements. The whole purpose of this rule is to make absolutely sure that the member actually has the real financial strength to handle the volume of business they are doing. By ensuring only financially solid members participate, it fundamentally helps in managing the overall risk right from the start. Next, we look at how money is collected upfront to cover potential losses, which is known as initial margins. The clearing corporation charges an upfront margin for every single open position a member holds. This is calculated and specified on a daily basis for each individual futures and options contract using a mathematical method called value at risk. To gather this money, the clearing member collects the required margin from the trading members below them, and those trading members in turn collect the required funds directly from you, the clients. Beyond that upfront deposit, we also have the mark-to-market settlement, which is a daily financial adjustment. Because market prices move up and down every single day, the settlement is done on a mark-to-market basis to account for those price changes. This process applies to the open positions of all members for every single contract they hold. Most importantly, this financial adjustment occurs right at the end of every trading day, making sure all profits and losses are settled promptly before the next day begins. To keep a close eye on things, while the market is actively open, the clearing corporation uses a real-time online position monitoring system. This advanced computer setup constantly watches the open positions of a clearing member minute by minute. It sets a specific trading limit for each member based on the effective deposits they have provided. If a member starts getting too close to their maximum limit, the system simultaneously generates alert messages, acting as an automatic early warning system. Now, let us break down exactly what rule violations the system is watching out for across different participants. The clearing corporation actively monitors the clearing members specifically for two main things, which are initial margin violations and exposure margin violations. On the other hand, the trading members are monitored for slightly different metrics. The system watches them closely to catch any initial margin violations and to ensure they do not commit any position limit violations. To enforce these rules across the market hierarchy, the system uses advanced trading terminals. A trading terminal gives the clearing member complete visibility, allowing them to monitor the open positions of all the trading members who clear and settle trades under them. This gives the clearing member the control to set specific limits for their trading members. The clearing corporation actively assists the clearing member in monitoring these limits during the day. If a trading member exceeds the limits set for them, the system takes immediate breach action and stops that particular trading member from doing any further trading. Finally, bringing all of this together is the most critical component of the entire risk containment mechanism for the futures and options segment. This is a powerful software system known as SPAN, which stands for Standard Portfolio Analysis of Risk. This highly advanced system carries out the actual online position monitoring and margining work. It calculates the online margins accurately based on a strict set of parameters defined by the market regulator, ensuring the whole market remains mathematically and financially secure.